Okay, good morning, ladies and gentlemen. Thank you for joining our latest series of webinars titled The Energy Sector in Artificial Intelligence Beneficiary. My name is Paul Duran on behalf of the entire team of ELCO Management. I would like to introduce Yves Siegel, our sub-advisor for the income infrastructure and energy transition portfolios. On last night's earnings call, Rich Kinder, co-founder and executive chairman of Kinder Morgan, highlighted the potential energy demand coming from data centers and artificial intelligence. We believe this call to be timely as the world tries to think about the rapidly changing environment. I would like to remind everyone that today's call is being recorded and a replay will be available. If any questions should arise, please use the Q&A tab on the bottom of your screen. Please see, I'm going to put up some important disclosures. And there we go. And with that, I'll hand it over to Yves.
All righty. Yeah, thank you, Paul. Good morning, everyone. And thank you very much for joining us today. I'm technologically challenged, but I think I'm going to be able to do this and share my screen. How's that, Paul?
You're good.
We're good to go? Great.
Good to go.
Okay. Again, hello, everyone. And we're going to just get right started. It's kind of obvious that I think that this is a wonderful time to invest in the energy sector. Okay, let's see. Here we go. So here's the agenda for today. We'll talk about energy rebounding year to date. We'll give you some reasons why we think energy is going to stay hot. I think the other part of this, which is really important, is the fact that we see secular changes as opposed to just cyclical changes. And then obviously we're going to talk about artificial intelligence and data centers and why that is a game changer. I also want to thank ELCO. Really appreciate the collaboration and also the fact that they've been long-term friends. That's my bio. Unfortunately, I don't quite look like that anymore, but I'm trying. So here are the key takeaways. Energy, once again, is performing quite well in this year. Year to date is the second best performing sector in the S&P 500. And I think it's really important to recognize that clean energy and the trends of clean energy are here to stay. Not a great investment so far today, but clearly it's a mega trend going on. I think the point here to make as well is that energy transition is taking much longer than anticipated, and that fossil fuels, oil and gas, will be needed well into the next decade. I'm going to just stop here for just 1 second. It's really interesting if you look at the forecasts that are out there. If you look at OPEC produces a monthly oil report, as does the International Energy Agency, as does the Energy Information Administration of the US. And if you look at the forecasts, OPEC thinks that energy demand over the next couple of years will grow about just over 2 million barrels a day this year, just under 2 million barrels a day next year. And if you look at the other two agencies, the International Energy Administration and the US EIA, they're projecting just over 1 million barrels a day. So OPEC thinks that demand for their product will grow twice as fast as the US and IEA. And from my perspective, the IEA is also calling for peak oil demand in 2030, by 2030. And here's the quick tagline. I think every year the IEA has to raise their forecast. Some might say that maybe they're biased a little bit and trying to promote clean energy at the expense of fossil fuels. I will tell you that I think both will be needed for some time. As Paul teed this up, artificial intelligence and data centers are a game changer. That's a good reason to be very bullish on the energy outlook broadly and for fossil fuels particularly. I'm not going to spend a lot of time on this as we go through the presentation, but I think no matter what political affiliation, Democrat, Republican, libertarian, whatever, the facts are clear. The U.S. is an energy powerhouse, and exports have been a dramatic positive for this country. We ship records amount of oil, we ship records amount of natural gas, and we ship records amount of natural gas liquids, primarily propane and ethane. And I really don't see that changing anytime soon. And then finally on this slide, I think valuations are quite attractive for the energy sector. And I think today we have an attractive entry point. I'm going to add one more bullet to this that I think is really important, and that is the narrative for energy, oil and gas companies is changing. And I think that is really powerful, because I think a positive narrative will have a huge impact on sentiment, which will have a huge impact on the demand for the energy stocks going forward. And this slide may look a little bit busy if you look at the graph, but it would shows you that in the first quarter, the S&P energy sector delivered a total return of 13.7%, and that compared really favorably with what the S&P did in the first quarter. On this graph, that is the energy sector is the blue line. The purple line is the S&P 500. And then we also highlight the subsectors. The midstream stocks were up just over 10%. Utilities actually, for the first time in a couple of years, actually had positive results year to date. And then the clean energy sector just doing really poorly, down over 10% in the first quarter. And that has as much to do with concerns about interest rates and cost of capital. My perspective, Siegel Asset Management Partners, we're really focused on the midstream in terms of our portfolios. You would think I would get this right going forward. And here are the reasons why we think energy is poised to remain hot. We think the fundamentals are quite positive. I talk about strong commodity prices. That's primarily oil. But I would submit to you that the stocks that we're investing in, if oil prices are $80 or oil prices are $90 or oil prices $70, I don't think that is going to have a big impact on how well the sector performs, at least from a fundamental viewpoint. U.S. production continues to grow. As I mentioned before, we have a vibrant, export market. And I'll talk about this a little bit later, but company financial positions are as good as they've ever been, at least for the 30+ years that I've been following the group. I don't think you can dismiss the fact that these stocks provide nice income and valuations are attractive. S&P dividend yield is just 1.4%. Broadly speaking, the energy sector is around 3%. And if you look at our midstream portfolio and midstream generally, you're talking about yields in the 5 to 7% range. The other nice thing about energy, it's a great sector as a hedge against inflation. I firmly believe that you will see, and we are seeing, a rotation into value stocks from the growth stocks. The tech stocks that did so wonderfully in 2023 are starting to lose the mojo. I think it's going to be replaced by energy. And then I think again what Paul mentioned to start, artificial intelligence is a major thematic that we'll talk about in a moment. Don't lose sight of the fact that energy demand worldwide will continue to grow. it's easy to see that you have rapid population growth, especially in the Asian economies. You also have GDP growth. Um, GDP growth means that you need to have more energy to support that. And then obviously, supply and demand. I just went over this with my son this morning, talking about supply and demand and how that impacts prices. I don't think you're going to see a tremendous increase in supply, but clearly as demand grows, you will see a positive impact on prices. The other 2 points here, the energy transition is here to stay. I like to say that the train has left the station, but it's going to take a lot longer. And not only is it going to take a lot longer, it's going to require, fossil fuels. When I went out on my own, the first report I wrote was the death of fossil fuels has been greatly exaggerated, to borrow from Mark Twain, and to borrow from some other pundits. We're really talking about energy addition rather than energy substitution or energy subtraction. And then again, we'll talk about artificial intelligence and what that means for energy demand, and the fact that all the above approach will be required. That means renewables, nuclear, and fossil fuels. Um, let's turn our attention to artificial intelligence in the data centers right now. And as Paul mentioned earlier, Rich Kinder on the Kinder Morgan earnings report last night started their conference call by highlighting the fact that data centers powered by AI will require a tremendous amount of power. You can see on the chart in the bottom, which my friends at Wells Fargo were nice enough to supply, that red line is projected power demand. Widely quoted, the Boston Consulting Group forecast that by 2030, data centers will account for 7% or more of the total electricity consumption in the US, and that's up from just 2.5% in 2022. Put that in perspective, it suggests that between now and the end of the decade, power demand will grow by about 20%. That's about a 3% annual growth rate. And by the way, I think natural gas will grow similarly through the end of the decade. The bullet point in the middle is taken from a Wells Fargo report, which they've updated a little bit. They expect incremental natural gas demand just from AI and the data centers will grow by about 7 to 10 BCF a day by the end of the decade. Their assumption assumes that natural gas will supply about 40% of the incremental power. 30% will come from solar, 30% with wind. Just to put that in perspective for you, right now, natural gas accounts for about 42 to 43% of US natural gas power demand. Solar and wind are about 11 and 4%, respectively, but are growing, quite rapidly. Just this year in 2024, the EIA expects that about 94% of the incremental capacity for power will come from solar, wind, and batteries, and natural gas just 4%. I think that's going to turn out to be way too low. And just turning to the way I think about secular trends and further reasons to be bullish on energy, I don't think this is quite appreciated, that there's been a dramatic shift, a paradigm shift in the business model, for energy. This idea in the decade of the 2000s and into the decade of the 2010s of a drill baby drill and grow, has given way to, from unprofitable growth to, hey, let's focus on returns on capital. Let's focus on generating free cash flow generation. And like anything else, when you get positive rewards, i.e. higher stock prices, you tend to change your behavior. Not only that, I started the presentation by showing you how well energy has done this year. It also was the best performer in 21, 22, took a pause in 23, but again is a tremendous performer thus far. And I think the secular change will will give way to higher valuations going forward. The other trend that's occurring as it relates to energy is consolidation. You're having the majors consolidate with big transactions from ExxonMobil looking to acquire Pioneer, Chevron looking to acquire Hess. In the midstream space, you had last year ONEOK acquiring Magellan. A couple of things to highlight. I think that word is really important in the middle bullet point. These are disciplined M&A. They are creative in nature, and the companies are looking to generate good returns on this. And we believe and we think time will generate evidence of this, that you'll have higher earnings, higher cash flows, and better returns from the consolidation trends. I think there's a huge amount of cost that will be wrung out of the value chain. I think you'll also see commercial gains, and the surviving companies are going to be bigger, better, and more valuable. I think you will have a bit of a scarcity effect there. And the last point gets us back to the data centers, and I'll go into this a little bit more on the next couple of slides. But the build out of the data centers not only will require more power, they also will require infrastructure, and that means energy infrastructure. On the utility side, it means transmission lines. For natural gas, it means that you will need to see pipeline expansions. And the LNG exports, power demand, but by the way, I should have mentioned, power demand isn't just coming because of the data centers. It's coming because of the electrification trend that we're seeing across the globe, especially in the U.S. Even though EV demand growth is slowing, guess what? I mean, it's going to require a lot of electricity. Here's other few points that I think are definitely important to highlight. I started off with this saying that I think the narrative and sentiment is improving, and you actually see that in how the energy sector has been performing over the past 3 years. I mentioned 22, 23. And even 21, 22, and 23, even though 23 was a down year, still energy was the best performer over those 3 years, and it's doing quite well now. I think yield plus growth is a compelling value proposition, and I'll talk about that again a little bit later. I think valuations are quite attractive. The chart on this slide shows you the energy sector weighting within the S&P 500. Right now, it's right around 4%. If you look across this entire period, going back to 1990, the average weighting of the S&P sector was more than double. Energy as part of the S&P was more than double where it is today. It averaged just over 8%. The low was reached a couple of years ago, but the energy sector weighting, the S&P had gotten to about 16% was the peak, and so I think there's plenty of room for expansion. I also think quite strongly when you think about the returns that you've seen in the S&P over the last couple of years. 20% plus market growth is not just, it's just not sustainable. And pundits really think that you'll probably see something less than 10% of reversion to the mean. I would argue that the energy sector relative to the S&P 500 looks quite attractive, especially when you look at yield plus growth. I'll talk about that when I get to the midstream section. But also when you think about where the multiples are for the energy sector. For example, the S&P 500 is trading around 21.5 times forward-looking earnings. The energy sector broadly is trading around 12.5 times, and it's only 4% of the market cap, but it's trading for almost half the earnings multiple of the S&P. And what I think is becoming more of a valuation metric that more and more folks are looking at, free cash flow. The energy sector generates about 8.5% of free cash flow relative to their stock price. The market's around 3.5%. So the way to think about that is the energy sector is providing more than twice the amount of cash that they can return to shareholders in the form of dividends and stock buybacks relative to the market. I think that free cash flow yield is quite attractive. And I don't want to just leave out clean energy. Fundamentals for clean energy will get better. It's growing. But the problem is that they have to finance that growth. And with high interest rates, that's creating quite a headwind for the group. And the other sort of point to think about is valuations. How do you value a stock? It's basically predicated on the present value of future cash flows. And if interest rates are high, the value of those future cash flows is less. And when you think clean energy stocks, their cash flows are going to grow. Their growth is a few years out. So the present value of those cash flows with high interest rates are fairly low right now. And this is a quick take on the energy transition. We don't want to lose sight of the fact that the energy transition is here. It's more here in terms of Europe, relative to the U.S., notwithstanding, the Biden administration putting a whole bunch of investment tax credits, production tax credits in effect. But it is here to stay. And I think what's most important is the growth in clean energy. The second bullet there is the one to highlight that renewable continue to gain market share. 60% of U.S. electricity generation by 2050 is expected to come from renewables such as wind and solar. I'm not sure if that number is going to be realized. I would argue that natural gas, nuclear might take a larger percentage of that. The other thing to highlight, and we've written about this in the past, energy security is national security. Russia's invasion of Ukraine was a wake-up call. The supply growth in oil and gas is going to be muted because essentially we're just not reinvesting enough. And as an aside, you can talk about drill, baby, drill, but I just don't think that the energy companies are going to drill, baby, drill unless it's profitable growth with high returns on capital. I am most bullish on natural gas, and I think the outlook for natural gas probably couldn't be better than where it is today. The graphic on the bottom right really shows just one of the reasons to be bullish, which is exports of natural gas are poised to double, perhaps more than double between now and year end. The second idea here to highlight, and Toby Rice of EQT, the largest natural gas producer in our country, essentially highlights this as well. Carbon emissions in the U.S. is declining because of natural gas displacing coal, as well as because of renewables. But don't lose sight of the fact that natural gas is aiding in terms of the decarbonization trend. And when you think about the data centers and artificial intelligence, what you need to also recognize is the data centers require power 24/7, 365 days a year. And wind and solar are just not available 24/7. But guess what? Natural gas and nuclear are available 24/7. The other aspect of this is that going back to the idea of data centers and artificial intelligence, wind and solar cannot keep up with the potential demand growth of data centers. You will require natural gas. That's point number one. Point number two, I mentioned that nuclear is part of the solution, but the problem with nuclear is you just can't build new nuclear plants quick enough to be able to handle the demand that data centers will require. In fact, you're starting to see the electric utilities, number one, extend the life of the nuclear plants, and number two, sort of recognize that they need to build more natural gas plants in order to in order to meet the demands of electricity. So I really, and Duke Energy is a prime example of this on the utility side. So I really think that you're going to see demand for natural gas sort of exceed expectations. When you take the 7 to 10 BCF a day of gas from power demand on the data centers, and you combine that with the growth of about 13 BCF a day from incremental exports of natural gas, you're talking north of 20 BCF a day of natural gas incremental demand between now and the end of the decade. If you put that on top of the current consumption plus exports of roughly 102 to 103 BCF a day, you can see that demand for natural gas potentially could grow by over 20% between now and the end of the decade. That's about 3% annually. That's a really, really big number in terms of energy demand. Over the past decade, power demand has grown less than 1%. It's been essentially flat. And now projections are that might grow by 3%. So energy demand is going to grow quite dramatically. This is my favorite slide in the whole deck. Midstream multiples are going to expand, in my humble opinion. What this chart shows you is midstream enterprise value to EBITDA. And again, my friends at Wells Fargo were nice enough to give me this graphic. But this chart goes all the way back to 2014. If you look at analyst reports today, the midstream stocks are starting to bump up against price targets. And I think the problem with that is that I think the analysts are being a little bit too myopic and just looking at the 5-year average. The 5-year average EV to EBITDA, which essentially is the metric that looks at cash flow valuations. It's basically looking at what is the value of the company divided by their cash flow. Today, it's about 9.5 times, 9.5 times cash flow. Over the last 5 years, it's been 9.6 times, but it's been as high as 11, and the average is just over 9.5 times. So that's why they're being somewhat neutral on the stocks. I would argue that if you take a longer term look, the median multiple is around 11 times. and it's gotten as high as 18 times plus. So the way to think about this, and this is really important, the way to think about this, if you get a one multiple expansion, i.e., instead of going from 9.5 to 10.5 times cash flow, which based on history is very, I think, plausible, that would represent a 20% upside in valuation of the stocks. And then if you layer on top of that dividends of 6%, and I'm not predicting this, but it's not unreasonable to think that you could get as much as a 25%, return by investing in the midstream stocks. So I'm really quite positive on the sector. And the other thing that I just want to mention that you should take away from this is what I'm describing in terms of demand for natural gas is not a cyclical type of phenomena. Somebody back in the 80s coined the phrase megatrend. This is a secular change. So there's a secular change in demand for natural gas going forward. There's been a secular change in terms of the business model changing, which is being, I think, underappreciated, i.e., these companies are in much better financial shape. They're generating significant amount of free cash flow. And I would argue that I don't think that's being reflected in the stocks today. And this is just saying the same thing a little bit differently. Energy companies have gotten the message. And by the way, I've been remiss. I should have mentioned also that when you think about the energy transition, the traditional energy companies are also investing in the energy transition. They are also investing in hydrogen. They're investing in carbon capture. They're investing in renewables, but they're doing it in a very measured way that basically generates good returns on capital. They're returning cash to shareholders. I think a winning proposition is a 6%, 7% yield plus 5, 6, 7% growth without any sort of uptick because you have a multiple expansion. It's not too difficult to think that the space without the multiple expansion that I just spoke about a minute ago can generate 10 plus returns. And again, beating a dead horse here, I think that's very competitive with a market that is richly valued. And I'm talking about the S&P 500 trading at 21 times earnings. And just to wrap it up, key considerations. You have the regulatory environment. The current administration hasn't been all that supportive of fossil fuels. But what I would suggest, and then I didn't mention it, but I'm happy if there's a question to talk about the LNG pause. But I think it's clear that there needs to be permitting reform, not just for fossil fuels for oil and gas, but also to be able to permit wind and solar as well. And that's a real potential headwind. There's always execution risk. I think the risk of inflation for the energy sector is somewhat mitigated, but you do have higher interest rates, and obviously we have the geopolitical risk that is being heightened. And just to wrap it up, the free cash flow generation, financial discipline leads to value creation. Longer term, we have the energy transition. And by the way, when you think about all of this, the terminal value for these companies is going to be pushed out way, way, way into the future. Unfortunately, when I'm not around, you will still be consuming a lot of oil and natural gas. I think valuations always matter. There is always a day of reckoning. And I think, as I've described in the prior slides, the energy sector midstream, I think is extremely compelling valuation here. My two portfolios, have done quite well. The infrastructure portfolio generates a 5% yield right now. We think 5 to 7% growth. 80% of the portfolio is in midstream. About 15% is in utilities, and the balance is in the clean energy. Clean energy, the energy transition is a similar strategy, just a higher weighting on the clean energy stocks. With that, I'm happy to take questions if there are any. I'm happy to mention the stock picks, the companies that we're investing in. What I would tell you is I'm most bullish again on the natural gas sector, and so as you can imagine, the weighting in our portfolios is geared more so to natural gas. Gosh, I guess I spoke for more than 30 minutes. Hopefully I didn't ramble. Hopefully I was clear, and hopefully, Paul, you might have one or two questions.
Yeah, Eve, thank you for that. Take a cue from you. How about a two-part question here? You described the demand outlook from OPEC and the agencies to start the call. Number one, maybe you can kind of give your outlook for oil and gas prices, and then secondly, maybe address the interest rate environment and inflation as it affects the sector.
Yeah, thanks, Paul. What's nice about, in my opinion, about the stocks that we're investing in, the fundamental earnings outlook isn't really going to be impacted a whole lot by the changes in commodity prices. Commodity prices obviously impact sentiment, which impacts stocks, but from a fundamental value, I think the growth in dividends is very much intact. I think commodity prices, most folks focus on oil prices. I don't think, unless, something happens to the Strait of Hormuz, I don't think we're going to have supply disruptions. And that's probably why we're seeing a somewhat muted response on oil prices. I think oil prices are going to stay in a trading range of, wide trading range of $70 to $90. And I think, when you think of the energy value chain from producers to the midstream, which is basically the infrastructure, to the end use, the refiners, I think everyone would be really happy and can make a lot of money in the range of $70 to $90. When you think about the producers and you think about the artificial intelligence, by the way, the cost of producing oil, or the break-even cost, keeps coming down because of the application of technology. So a lot of these companies on the majors can make a lot of good returns with oil prices well below $50, with oil prices below $40. So it's a long-winded answer to the commodity price on oil, but I think set widely 70 to 90 is probably a reasonable forecast for oil. And then as it relates to natural gas, natural gas is so weather sensitive. Right now, natural gas is trading below $2. I think it's a nadir for natural gas. I think it's bottomed. I think a more reasonable price for natural gas is somewhere in the $3 to $4 range. I also think that you're going to need natural gas, well above $3 to be able to coax more production, especially as it relates to the East Coast. If the demand forecast is right, we just are not going to be able to rely, in my opinion, just on the Permian Basin, which is Texas and New Mexico, the Haynesville, which is Louisiana. I think we're going to need more than natural gas from those basins. I think you will need the gas coming from Pennsylvania or Virginia, and for that to happen, I think you need higher natural gas prices. And I also just want to underscore what I said before, which I think is so important, which is that financial discipline has basically come to the energy sector. And when it relates to natural gas, we've seen producers cut back on their natural gas production because of low prices. They've cut back on the amount of drilling because of the low natural gas prices. So the energy sector is disciplined, And they're not just talking the talk, they're walking the walk as well. And I think over the last few years, there's been substantial evidence of that. And again, I want to underscore this. I think the narrative and sentiment for the energy sector is improving, and that should be reflected in higher stock prices.
Great.
Paul?
Yeah. So Eve, there's one question in the queue, and maybe I think it's probably a great way to kind of conclude this. Asset allocators often push back that investing in energy midstream is too risky or volatile. What are your thoughts here specifically for folks trying to asset to the space going forward? I'm trying to allocate to the space going forward.
Gosh, yeah, that's a great question. You know, the one of the slides shows that energy represents just 4% of the S&P 500 right now, and it's been more than double that over the last few years. You know, on average, I think any equity portfolio should be overweight energy. And what does that mean? It means I think portfolios should probably have anywhere from 5 to 10% of their equity exposure allocated to the energy sector. And within that, again, I might be biased, but my favorite sector from a risk reward, from yield and growth would be you know, the midstream sector. So I think you need, and you should think about allocating a nice portion of your equities to the sector. And the other thing that I think is worth mentioning, and again, I tried to underscore this, the energy sector has evolved over the last few years. And unfortunately, some investors' memories, you know, sometimes just way too long, and they don't recognize when things have evolved and changed. And so they go back to when you had the crash in the energy sector, when OPEC decided to teach the U.S. a lesson and gain market share, yet oil prices collapse. The energy sector is so different today than it was back in 2014. Balance sheets are so much stronger. You know, one of the reasons midstream stocks went down was this notion that their customers were going to go bankrupt. And that was a real concern back then. But guess what? Their customers, like Jamie Dimon likes to say, you know, have bulletproof type of balance sheets now. The leverage is less than 1 turn. I mean, really strong. And they're generating some significant amount of free cash flow. And they're not reliant on having to go to the equity or the capital markets. Yes, they might refinance debt, but the absolute level of debt is actually going down. So, you know, don't be biased by the fact that the sector did poorly, you know, 10 years ago. You know, be biased by the recency experience, which is that the energy sector is doing much better. And I would submit to you that I think the long-term outlook for the energy sector is quite good.
All right, great, Eve. That's all the questions we have. So if you want any concluding remarks.
Yeah, well, I probably spoke too long, but you can tell my enthusiasm for the energy sector, and I welcome anyone you know, to give me a shout, email me, email Paul and ELCO if you like to talk about you know, further discussion. I put out a monthly. In fact, my last monthly proved to be, you know, relatively timely, where I spoke about or wrote about artificial intelligence and data centers. So if you would like to be put on my distribution list and you're not there, you know, I write the commentary monthly. And with that, I really appreciate everyone's attention and good luck in the stock market. Thank you.